Today is Monday, August 18th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, ADMIS Senior Ag Analyst, Mark Bowman, ADMIS Senior Market Research Analyst, and JP Steiner, ADMIS Associate Economist. Starting with the grains this morning, Mark, with last week's USDA report behind us, what will drive grain prices across the ag space this week?
Yeah, USA reports last week certainly had its share of surprises. To me, the biggest surprise was the significant cut in soybean acres and increase in corn. Soybean acres were down 2.4 million from just what the USDA had reported just a month prior. So to me, that makes having record yields here in the U.S. just that much more crucial. The only year where we saw this big of a cut or anywhere near this big of a cut in soybean acres was back in 2019 when acres fell 3.4 million. In 2019 also happened to be the first trade war with China under the President Trump's first administration. That year, we actually saw final yields down another million. So August also happens to be the crop tour season, just ahead of the Midwest harvest. This week, the Pro Farmer Crop Tour will cross the nation's midsection, likely supporting the record yields as forecast by the USDA last week. However, I would not be surprised if they find some evidence of pollination issues due to midsummer heat, and also even some potential damage from these recent storms and high winds. If energy prices see some wild swings driven by the peace talks between the Trump administration and European leaders, including President Zelensky of Ukraine, that could spill over into the ag space. Otherwise, I'd expect kind of rather quiet trade this week, as perhaps a little bit of a calm before the storm being this year's U.S. harvest. It will wait to see if the U.S. yields do live up to these records as suggested by the USDA, and also whether these record demand numbers hold up as well. Right now, speculative traders seem to be a little bit more inclined to cover some of these short positions in corn and soybeans, perhaps just sensing that the downside might be a little bit limited at the moment.
Mark, let's say the U.S. doesn't get a trade deal done with China. How will this further impact soybean prices?
I really don't think it's going to have as big of an impact as is previously feared. Yes, the Trump administration seems to have placed carving out a trade deal with China a little bit on the back burner for now. However, we are keeping tariffs at much lower levels than previously feared. China has not bought any new crop soybeans from the U.S. just yet, as they continue to buy from South America. Normally, by now, they would have started to shift some of these October, November purchases to the U.S., but we're in a global marketplace. The more China buys from Brazil, the less that Brazil can obviously sell to everyone else. U.S. exports to other countries than China are running well above Euro pace and keeping the supplies much tighter than the last time we had a trade war with China. So right now, there's nothing that has changed the longer-term trend with here in the U.S. as we use more and more soybeans domestically crushed for biofuel production, and we export less and less. So I really think that finishing weather here in the U.S. and early planting conditions in South America, they'll begin planting their crop here next month, I think are going to be much more crucial than the trade talks here later this fall with China. I think the lows are in the soybean market. I think we're going to chop around about a 10 to 10.75 price range, just waiting to see how we finish off the U.S. crop here this fall.
Thanks, Mark. JP, after last week's inflation data, what are expectations for Mr. Powell and the Fed?
So just going over last week's inflation data, that was somewhat of a mixed bag. CPI inflation data showed that inflation in July was modest. Headline CPI rising 0.2% month over month, down from 0.3% in June. Core CPI rose 0.3%. Now that was up from June's 0.2% and the largest gain in 6 months. Reflecting more broad, persistent price pressures, especially in shelter, medical care, recreation, and travel. Food prices were flat as grocery costs dipped slightly, while restaurant prices rose. Energy prices also declined, led by a 2.2% drop in gasoline. That helped offset broader inflation. However, PPI inflation was a much different story. final demand prices rose 0.9% month over month and 3.3% year over year. That marked the strongest annual increase since February and reflected broad-based price pressures, especially in services, which rose 1.1% on the month. Services sector was driven higher by higher trade margins, transportation costs. Good prices also climbed, led by a 38.9% spike in vegetable prices, alongside increases in energy and core goods. This differed starkly from the CPI inflation reading, which those sectors actually saw a decline in prices. Core PPI, which excludes volatile energy and food prices, rose 0.9% in July. That was the largest monthly gain in 3 years and is up 3.7% year over year. So that is helping suggest that underlying inflationary pressures are sticking around and are less sensitive to just seasonality and commodity cycles. Meanwhile, the uptick in core PPI is a warning sign that inflation also might be rising quicker than the Fed expected, which could influence the Fed's stance on interest rates. PPI inflation is often referred to as pipeline inflation because it measures costs in the supply chain, oftentimes a leading indicator of CPI inflation, although it's not always one-to-one or immediate. However, given the inflationary print from the PPI data, especially the sharp rise in the services sector, I would expect the Fed to only cut rates one time for the remainder of the year, as long as monthly payrolls maintain a growth of 75,000 or more.
And JP, what will drive equities this week?
Yeah, the talk of the markets this morning is certainly the meeting taking place between President Trump, President Zelensky, and other European leaders following a summit between President Trump and President Putin in Alaska on Friday regarding the war in Ukraine. The outcome of this meeting is likely to impact markets across the financial space. Any positive outcome likely to offer the equities a good amount of support. On the corporate calendar, results from Walmart, Target, and Home Depot highlight the end of the earnings season, especially a slowing earnings calendar that really sees the retail sector as the main focus and could offer some really good clues into consumer spending. Last week, the Dow climbed 1.71%. The Nasdaq added 0.94%, and the S&P added 0.94%, and the Nasdaq gained 0.8%, with all three indexes hitting fresh highs. Markets are increasingly expecting the Fed to cut rates in September, even after the recent inflation data painted a mixed picture, and especially since the unemployment picture is looking a little bit more dim than we have been used to. Markets are also awaiting remarks from the Federal Reserve's Jackson Hole Symposium for any sort of policy signals. The symposium runs Thursday through Saturday, and Fed Chair Powell is giving a speech at 9 a.m. Central Time Friday, likely his last at this event. The minutes to the last Fed meeting are also due Wednesday and will be closely watched. Markets are pricing in an 84.9% chance that the Fed will cut rates in September. Elsewhere on the data front, housing starts data for July will be released Tuesday. U.S. Purchasing Managers surveys on manufacturing and services activity in August will be released Thursday. Additionally, the Philadelphia Fed Manufacturing Index for August will be released Thursday, with economists expecting a reading of 5.9, which would be down from July's 15.9, as markets wait to see how manufacturing activity has been dented as a result of tariffs. Thursday, we'll also have weekly initial jobless claims data, which has garnered a little bit more attention than normal, just given the disappointing jobs data we saw last month. Then on Friday, as I mentioned earlier, all eyes will focus on Powell's speech in Jackson Hole as markets try to gather just any sort of signal on what the Fed will do next.
Thanks, JP. Mark Bowman, looking at the crude oil market, what do the latest Baker Hughes rig counts have to say about U.S. crude oil and natural gas production?
Okay, starting with crude oil, the Friday's count had we were up one rig last week to 412. This is down though from 483 a year ago and below the 5-year average of 436. But we're up a little bit from August 1st when we reached a 3.75 year low of 410. So the important question is, whether last week's recovery is the mark to bottom, or whether they'll resume a decline. At this point, though, there doesn't seem much reason for room for expansion because of the because prices are so low. Now, the gas rig count went up last week to 122. This is compared to 98 a year ago and a 5-year average of 108. And they're just off their peak of 6.5 years at 124. Seems like the trade is counting on the expansion of U.S. LNG exports. Also, though, gas production is at a record last week, 108.2 billion cubic feet per day for August so far, versus a record of 107.9 in July.
And lastly, Mark, what did Friday's Unica report say about Brazilian sugar production?
So the report did show production for the cumulative production since the marketing year began in April was running 7.8% below last year. That's an improvement from being 9.2% behind as of mid-July and 14% behind at the end of June. We did see a recovery from June. June was we are now production last month for the first half of the month was 15% above last year after averaging 18% lower in June. So first half of June saw a good recovery, but then the second half of July saw we were close to last year, 0.8% decline. So we did see dry conditions emerge in July that were conducive to harvest, but that we could see a limit to the gains, I think, as we move forward, because certainly we're no longer, at first half of July was real strong, the second half, okay. And the one supportive thing for production has been that the crushers do seem to be focusing more and more on sugar as opposed to ethanol. We're up 54.1% of the crush going to sugar production versus 50% a year ago.
Thank you all. Remember, the views and opinions expressed today in this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.